Hi everyone, welcome to a brand new episode. I'm Marcus. Today we're looking at Microsoft. We'll cover income statement, balance sheet, cash flow, key figures, and our key feature, and lastly, our technical analysis. We have a jam-packed episode. This one you don't want to miss. All right, let's go. As I mentioned, we're going to take a look at Microsoft, and they are traded on NASDAQ and are in the technology sector. If we go over to the screen, we can see that their market capitalization is at $2.3 trillion and their revenues are $176 billion. Their PE ratio coming in at 34. Normally, I like a PE ratio of 20 or below. So having 35, that is too high for me. So that is a no. Now, guys, when you see a stock with a high PE ratio, that tells you that the market expectation of that stock is high. And there is a good chance that you will see capital gains on those stock. But there is an overhanging risk here. If the company doesn't meet those expectations, we will see the stock price fall. Same thing goes when you see a company with a low PE ratio. That tells you that the market expectation of that stock is low, and there is not a good chance for you to see capital gains on those stocks. Just have that in mind. Now, the profit margin is at 38%. I like it. I like companies with a profit margin of 15% or higher. So coming in at 38%, I like it. So that is a go. Price to sales ratio coming in at 13. I like companies with a price to sales ratio of maximum 4. So having 13, that is just way too high for me. So that is a no. Price to book value at 16.9. Normally, I like companies with a price to book value of maximum 3. So having 16.9, that is just way too high. So that is no for me. Now, if we were to summarize, PE ratio too high, price to sales ratio is too high, and the price to book value is too high. So that tells me that Microsoft at its current state is overvalued. Now, they pay out a dividend at $2.30. I like that because I like those income. So that is a go for me. Now, effective return at 0.81%. That is a bit low. So that is a no for me. I would like to see a number of at least 2.53%. That would be acceptable. But 0.81%, that is a no. Return on equity at 49%, I like it. Return on equity tells you about a company's ability to create a return on their equity, and it's critical that you have a company with a positive return on equity because that tells you that they are able to create a return on the capital you're about to invest in them. So 49%, I like it. Return on assets coming in at 14.6%, I like it. So that is a go for me. Now, the stock is currently traded at $310 per share. If we go over to the moving average, we can see that we are below the 15-day moving average, but above the 200-day moving average. This tells me that there are uncertainties here, and there's no telling whether we'll see the stock price increase or if it will decrease. But if we glance at the chart, we can see that we have been moving in a positive trend channel, and lately we have seen a bit of consolidation, and the price actually broke down from the channel. So we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement. And what we can see here on our income statement is that the total revenue went from $96.6 billion in 2017 and grew to $165 billion. And the trend has been positive. I like it. Gross profit went from $62.3 billion up to $115.9 billion. And also, we have been growing every year. I like it. Net income went from $25.5 billion up to $61.3 billion. We fell off 1 year, but overall trend has been positive. I like it. Let's jump over to the balance sheet. And what we are interested here is that the current assets versus the current liabilities, and we can see that there's a huge difference between the current assets and the current liabilities. Basically, if the company were to convert their current assets to cash, they're able to pay off their current liabilities, which I like it. Now, they're not far from being able to pay off their total liabilities, which is great, but If we take a close look at the total liabilities, we can see that it has been growing from $162 billion up to $191 billion, and the number have been growing steadily every year. We've been stagnating a bit, but the last year we grew a lot, so that is a minus. I would like to see the company start reducing their total liabilities. Let's jump over to the outstanding share. We can see we went from 7.7 billion up to and down to 7.5 billion outstanding shares, and the number have been going down for the last 5 years, which is positive. I like it. Basically what happened is that the company is doing buybacks, and that means that your share of the companies is growing. And it's very critical to take a look at this, because there is a lot of investors that either skip this part or doesn't know about it. But what happened is they be looking at the balance sheet and they see a strong balance sheet, the company is having strong assets, and the debt's not growing that much, which is great, which is positive. But on the other hand, you see companies issuing a lot of shares, and what happened is that your share of the company is being diluted, it's decreasing, and that's a way for a company to bring in more capital without taking on more debt. So be very aware of that and be cautious. Let's jump over to the cash flow, and what we're interested in here is that the operating cash flow versus the capital expenditure. And we can see in 2021 the operating cash flow landed at $76.7 billion and the capital expenditure at $20.6 billion, a difference of $56 billion, which is great. I like that. And we can also see that the operating cash flow went from $39.5 billion up to $76.5 billion, and the number have been growing steadily every year. I like it. We can also see that the capital expenditure have grown every year. I like it. That is positive. I like that they continue to invest in the business. Now let's jump over to the key figures. And what we can see here is that the earnings per share went from $3.31 up to $8, and we fell off 1 year, but overall trend has been positive. I like it. Revenue per share went from $12.5 per share up to $22 per share, and has been growing steadily every year. I like it. Equity per share went from $11 per share up to $18.8 per share. We fell off 1 year, but the overall trend has been positive. I like it. Dividend share went from $1.54 up to $2.20, and also the number have been growing steadily every year. I like it because I like those recurrent income, and also the fact that the income have grown every year, so that is a positive. Now dividend share has been fluctuating 46, 76, 30 and 29, so forth, and that is a positive. I like companies that pays out less than 60% of the capital, because I want some of the capital to remain in the business for investment, acquisitions, and just overall strengthening the business. So that is a plus. I like it. Gross margin went from 64.5% up to 69.8%, and also the numbers have been growing steadily. We fell off a bit 1 year, but overall trend is positive. I like it. Operating margin went from 30.9% up to 42.8%, and also the number have been growing steadily every year. I like it. Profit margin went from 26.3% up to 36.9%. We fell off 1 year and grew and then fell off. So a bit of fluctuation, but overall trend here is positive. I like it. Return on equity went from 29% up to 43%, and all we fell off 1 year, we grew and fell off another year, but overall trend is positive. A bit of fluctuation, but still positive. Return on assets went from 10% up to 18%, and we fell off a year, grew, and then been growing every year since then. So that is a plus. I like it. Solidity tells you about a company's financial strength for the long term, and here we went from 35% up to 42.5%, and the numbers, we fell off 1 year, but the numbers have been growing steadily every year. I like it. Now, balance sheet liquidity went from $1.38 up to 1.79, and the numbers have been improving every year. I like it. Balance sheet liquidity tells you about a company's financial strength for the short term. Debt ratio went from 1.85 down to 1.35, and also the numbers have been falling every year. I like it. So this tells us that in 2021 they had debt ratio of 1.35. That means that the company had 1.35 times more debt than equity, and seeing that the number is getting lower and lower, that is a plus. I like it. Guys, we have gone through the income statement, the balance sheet, the cash flow, the key figure, and now over to our key features, which is the pillars. And basically what the pillar does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If you go over to the screen, we can see that the PE ratio is above 20, which is negative. The company do pay out a dividend, which is positive. I have to report this one. And the dividend payout shares is less than 60%. I like it. That is a plus. Dividend increased over the past 5 years. That is a plus. And the numbers of outstanding shares have decreased, which is a plus. Revenue increased over the past 5 years. That is a plus. And profit margin also, I have to report, is a plus. Profit increased over the past 5 years. That is a plus. Current assets greater than current liabilities. That is a plus. Solidity increased over the past 5 years. Plus. Balance sheet liquidity decreased over the past 5 years, plus. And debt equity ratio decreased over the past 5 years, plus. And total liabilities have grown over the past 5 years. That is a minus. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. As I mentioned, if you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. You can have everything we've gone through, plus the pillars, along with the access to the discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to jump over to commerce.sc and become a member today. But let's jump over to the technical aspect of the stock. So here we have the chart. Let me just lay down the support line, something like that. And let me also do one. Let me change that color, by the way, to green. And let me do for the resistance level something like that. And let me change that color to red. As you can see here, so we have been moving in a positive trend channel, and lately here in September, October, November, we broke out of that channel and have been moving higher levels. Now I believe were a lot of investors that were looking for a way to enter the trade, because when we broke out of here and did a retest, a lot of investors, I believe, were waiting for the stock price to move even higher and break this area in order to enter the trade. But we could see that what we instead got here was an ascending triangle, meaning that a lot of investors were participating, just waiting for the stock price to continue to move within the triangle. But what happened is, I believe this is due to what's going on in the overall economy with the Fed tapering, the expected price increase, supply chain, with everything that's going on has affected the stock price, and therefore we can see that the stock price fell down back to the trend channel here, and we are currently traded at $310. So this is a great area to enter the stock. You can see here that this is the key areas. We've been here before, and so there's a lot of buyers entering and looking for ways to enter along the support line. So I'm looking for a way to buy the stock as it gets closer to the support line. I'll be buying, because this is a great company. The financials is looking great. The forecast is looking great. So I'll be buying Microsoft. How would you trade the stock? Please let me know in the comment sections below. And I hope you have enjoyed this episode. And please give me a thumbs up, comment, subscribe. And till next time, guys, take care. Bye-bye.